welcome to a quick run through of the top 5 charts of the week, just add a little bit of extra context and comments. And this is the free weekly email that goes out to subscribers of the website. First one is US government investment, and you can see here that it's at historical lows. We've got both federal and state and local net investment as a percentage of GDP. So you can see there, in that that post-war boom period, a lot of government expenditure on investment at that point, and then sort of fell down into a new range around 1.5% of GDP from the 70s through until very recently, where it's at an all-time low, and it makes it pretty clear, I guess, why the US rates relatively poorly on infrastructure and why there is that desire to push forward with some infrastructure spending. Certainly one to get the cogs turning in the head, that one. The next one is a picture of REIT, so Real Estate Investment Trust, ETF assets under management. And this one I feel is quite interesting to see here how, when real estate was split out as its own sector, own GICS or GICS sector, turned out to be the top. There's quite a few other things going on that turned out to be the bottom for bond yields. So of course that's going to be problematic for REITs. Rising yields can tend to be a bit problematic, particularly when probably a lot of this growth in AUM has been driven by the search for yield itself. But on the topic of GICS changes, it's sort of an opportunity to talk about what's coming in September this year. And that's a change in the telecom sector. So the telecom sector is very small now. It's just over time grown to be, well, not grown, but diminished to be a small, very small part of the S&P 500, and it's going to get a bit of a shake-up. It's going to be renamed Communication Services, and it's going to be two industry subgroups. One's telecoms, it's the same thing, and the new one's going to be called media and entertainment. So I don't think that telecoms after this change is going to be the same kind of defensive sector that it used to be. So big changes here, relatively speaking, and a few other bit of shake-ups going on too. A few companies are going to get taken out of technology and either put into this new sector or consumer discretionary. So that is one to keep an eye on, one thing to be informed about. Quantitative tightening and bond yields. So we've got the Fed tomorrow morning. Expect them to do nothing. But, in their March meeting, one thing that they did do was increase the pace of quantitative tightening as planned. And the next planned movement will be in July and then again in October. And October is where they'll be running at the full pace of 50 billion a month for quantitative tightening if all goes to plan. And here is the first look at the impact of quantitative tightening on financial markets. So yes, I did fine-tune the axes quite a bit on this, but just goes to show that definitely there were other things going on. But when you see the Fed begins QT at this red dot here, and remarkable correlation there, at least for a period of time, with the reduction in the Fed holding of treasuries seeming to line up with the push higher in bond yields. So it's a pretty key supply and demand dynamic there. If you think about the Fed, reducing its reinvestment into treasuries, so it's basically reducing its purchases of treasuries for quantitative tightening. But also, fiscal deficit is going to be rising, and that's going to mean more issuance as well. So, I think that the growth inflation outlook is consistent with higher yields, and then you've got this supply-demand backdrop, which is also consistent with that. And then also looking at quantitative tightening versus the stock market, bit of a delayed reaction there, and that last surge, I guess you could explain that was down to the tax cuts, which kind of offset that. But it's going to be interesting to see how this plays out, because one of those popular or infamous charts that people were wheeling around in the last sort of five odd years was a view of the S&P 500 going up with the Fed's balance sheet also going up, and basically the implication being that march upward in the stock market was just purely as a result of Fed quantitative easing. Of course, it was many other things than that. Earnings were actually going up, and I've been in that camp for some time that was highlighting that. But you know, it would be wrong to say that it wasn't a factor. And if it was bullish on the way up, it's probably going to be bearish on the way down. So I still think that we go higher from here on the stock market, but I think that as we progress down the quantitative tightening path, we're going to see more corrections, more sell-offs. It's going to be more volatile ahead. The easy part of the cycle is definitely over now, but the cycle itself is not quite over. And one thing that makes corrections and sell-offs more dangerous, well, certainly makes a bear market more dangerous, is this amount of leverage that's been building up, investor leverage. So this is leverage that investors have been using to increase their exposure to stocks, ideally to rising stocks. And it's made up of net margin debt, net leverage ETF AUM, and net speculative futures positioning. And bottom line is it's gone up about 400 billion over the past 5 years, and that's a reasonably material amount. So that's it. We'll leave it there, and if you want to receive this in your inbox, I will put a subscription link in the YouTube video description. Otherwise, if you've got any comments, questions, put them below, and be sure to subscribe to the channel so that you don't miss out on any updates.